All right, welcome to today's explainer. Today, we're diving into a massive, frankly wild, narrative tension that's playing out across the entire global economy right now. We're looking at this spectacular collision between unbelievable, unprecedented AI acceleration and the massive, very real-world costs it takes to actually keep this thing running. We've got skyrocketing revenues, mind-bending software efficiencies, and, well, a bill that is finally coming due. We've got a lot to cover in this high-velocity briefing, so let's just jump right in.
Okay, let's dive straight into this number, $12.7 billion. According to some recent IPO filings, that is exactly how much SpaceX spent on AI in 2025 alone. Just to put that into perspective for you, that's more than 3 times what they spent on Starlink and their entire space business combined. Insane, right? And the sheer scale of this AI infrastructure push is so massive that SpaceX is actively planning orbital AI data centers by 2028. Why? Literally just to tap into abundant solar power and avoid all the severe permitting and land constraints we're facing right down here on Earth. It's honestly like science fiction happening in real time.
And you can see exactly where all that capital is flowing when you think about this massive 36% year-over-year jump. TSMC, the world's absolute leading chipmaker, just posted a record-breaking second quarter revenue of $39.6 billion that is driven directly by this totally insatiable demand for AI chips. Meanwhile, in the middle of all this hardware chaos, Apple actually managed to capture a record 20% global smartphone market share. How did they pull that off? Simple. By holding their iPhone prices flat while rising memory chip costs forced literally all of their competitors to hike their prices. A total game changer of a strategy.
But look, this acceleration isn't just about the hardware side of things. Take the number 286. That's the total number of people the Italian software company Bending Spoons hired in 2025, out of a staggering 800,000 applicants. This is the super concrete benchmark for what we call AI-driven workforce compression. Because AI actually automated 90% of their code pull requests by early 2026, Bending Spoons was able to push their revenue per employee past $2.57 million. Talk about doing more with less. It's a prime, real-world example of the extreme software efficiency AI is enabling right now.
Now, what's really fascinating here is the pivot. On one side, we have these incredible, almost unbelievable technological leaps, right? We've got Elon Musk claiming Grok 4.5 is breaking speed records, and Google's Gemini 3.5 Pro dropping a massive 2 million token context window. But on the other side, the bill is finally coming due. DRAM memory costs are up a whopping 98%, and energy prices are absolutely surging. The sheer cost to fuel these frontier models is astronomical. So the crucial point here is the real-world friction we are all starting to feel. We're looking straight at the inflationary reality of AI. Because data centers are absorbing so much electrical capacity right now, Goldman Sachs is forecasting utility prices will actually rise 6% this year and next. And remember that 98% surge in DRAM prices we just talked about? Well, it means economists are warning that consumer electronics inflation is going to stay elevated, and we're already expecting iPhone 18 price hikes this fall. The bill is so steep that tech stocks actually took a hit recently, as investors seriously began to step back and question the timeline for when all this massive AI spending will actually pay off. Which brings us to the real gravity of the situation, and it's perfectly captured by analysts over at the US Treasury. They recently concluded that this infrastructure boom is now, quote, too entrenched to unwind quietly. Basically, they're warning that if we see an AI downturn or even just a serious delay in return on investment, it won't happen in a vacuum. It would violently cascade through equities, private credit markets, and of course, all those utility companies that have literally bet their future capacity on AI load growth. It's all connected now like a giant puzzle. And you can really see this urgency building up on a regulatory level too, as governments scramble to build in fail-safes. In the UK, regulators have done something totally unprecedented. They've placed major cloud providers, we're talking AWS and Azure, under systemic financial risk supervision. Meanwhile, over in the EU, as of July 7th, every new car must have mandatory AI-powered gaze monitoring just to detect driver distraction. And in China, President Xi Jinping is using the World AI Conference to actively push for international AI governance. The entire world is reacting to the sheer momentum of this technology, and they are moving fast. And that all leaves us with this final unresolved question, highlighted recently by the Washington Post. As we deploy these models faster than ever before, and as the infrastructure costs just continue to soar into the stratosphere, when an autonomous AI agent goes wrong, who is responsible? Is it the developer, the deployer, or maybe the user?
It's a hugely provocative question sitting right at the intersection of breakneck innovation and real-world liability. So, what does this all mean for the future? Definitely something to think about as you watch this space. Thanks so much for joining me for this explainer, and I'll catch you next time.